Good afternoon, everyone. We got Matt out of bed. He's on. He's ready. Rocking a polo with his hoodie. I tried dressing like him, and he dresses differently. I don't know. I don't know what's going on here, everyone. Matt,
well, I'll tell you what's going on here. It's the apocalypse here in good old Houston, Texas. Everybody's shutting down early, and everyone's like, it hasn't even gotten to like a slightly warm day New York temperature, and people are like, nah, we got to shut down early. It's 41 degrees. So it's been pretty interesting doing the rounds today and saying hi to the folks and of good old Houston, and everybody's all scared for the snowpocalypse of 2026 here in Texas. So
the snowpocalypse. Well, thank you everyone for being here. Chels, what's going on? June, what's going on? Spencer, what's going on? Spencer's here. That means that there's trouble in the house. We'll probably get a few thumbnails during the episode. But before we get to that, please read the disclaimer. Matt and I have no idea what your situation is. We are not financial advisors. We are not your financial advisor. Anything we say are our own opinions. Please do your own due diligence. And remember, all investments carry risk. Now, before we get started, I do want to show something. Now, I'm sitting here trying to work, trying to do stuff, and Matt just starts sending me random stuff. And I think everybody knows what happens when Matt just sends random stuff, right? Stuff like this happens.
I'm the lead singer, Leonard Skinner.
But it doesn't stop here, everyone. It doesn't stop here. Then, Matt and I taking everybody out.
I said Bad Boys 2. Shootout scene. This is what it came up with.
I don't hate that. And then what did you put in for this one?
Full disclaimer, guys. I don't always want to show up as the hero. But for some reason, Gemini, I don't know if they're trying to appease my ego or you know what. I always say, take one of these portraits. I take a beautiful portrait of Steve, take a beautiful portrait of me, and I give it to him. I said, make one of these persons, like just like the other night when I said put one of us under the bridge in a box and one of us in a penthouse. It chose Steve to be under the box. And then I said, choose one of us to be jumping off a building with an explosion going off, and the other one saving the other, putting their arms out. It makes me the guy, the hero, and then same thing. The inspiration for the lead singer one was, you guys remember from Talladega Nights where everyone's trying to picture what their Jesus is, and Will Ferrell was just like, I like the Christmas Jesus best, so that's how I describe him. And Dale says, I picture my Jesus as the lead singer, Leonard Skinner. And he's wearing a tuxedo t-shirt because I like my Jesus to party. And I'm in the front row, hammer drunk. And so I said, pretty much verbatim that. And I said, choose one of us to be the lead singer, Leonard Skinner with long hair, and the other one to be hammer drunk in the front row. So.
I don't hate it.
And it just always chooses me to be the hero. I don't know.
Listen, but you are the hero, though.
Some may say I'm the chosen one.
I mean, I would say you're the chosen one. You did invest in Rocket money. You are the chosen one.
Anyway, I'm just happy to be here, Steve. Thank you for offering to have me on. It's always a blast.
To badger you to come out and stream on a Saturday instead of watching TV?
I mean, otherwise I'd just be like, I don't know, playing World of Warcraft or doing something. That's not.
Before we get into stocks, I have to say I finished season 2 of Landman.
Mm-hmm.
I'm just going to say it. Taylor Sheridan's amazing. Landman is freaking amazing. It is rivaling Yellowstone, in my opinion. And it is so freaking good. They cannot make season 3 quick enough.
You think there's reason to be a season 3, Steve?
If there's not a season 3, I'm going to be really pissed off.
Yeah. Well, first and foremost, I hope hope Paramount's listening because you don't want to see Steven pissed off.
I'm just saying, Billy Bob, get it done. Get it done.
You heard it here first. I like it.
See, I love this. Steve is chocolate wasted. Grown-ups reference. Chocolate wasted's amazing. Love it. May I pull out the chocolate milk tonight on the stream? We'll see.
Landman is better than Yellowstone. Steve, thoughts?
I don't know about that. It's hard to say Landman's better than Yellowstone when there's only 2 seasons, but it's really freaking good. It's really good. And for the UFC question, I think Paddy the Baddy is going to take it. I think he is going to take out Gaethje. Gaethje's amazing. I just don't think his chin is what it once was. He's been in too many wars. Paddy's he's on a tear. I think he's going to win.
Steve, I like it.
Shells, you're into Yellowstone? Show is so good.
I want to let me.
Oh no, Matt's trying to do something. Matt, what are you doing?
No, I'm trying to be better, Steve. And in the pursuit of being better, it takes a lot of time and effort, as you know. I'm trying to start to upload my old podcasts to Spotify. So
look at you getting after it. I like it.
Yeah, I mean, I'm not trying to get into different like segments or anything. All Matt Money appearances are now just Matt Money podcasts on Spotify. So if anybody's interested and they want to use that or follow or anything like that, so that if they're ever working out and they still want to be a part of it, I'm trying my best because I know some people don't have the opportunity to watch the video, but I am uploading the videos. It's not just audio, but I'm trying my best to make sure that I say numbers instead of just being like, look here. I'm trying to be like, it went from $64 to $85. So that way people that are listening can at least, follow along without having to see the visuals, but sometimes it's difficult. So, but it's making me wait. I don't know why it's taking a minute, but
no bueno. No bueno. All right, Matt, we got a big week ahead of us. We have
big week.
Well, maybe before we get to the big week, we had a good week this week. I mean, everybody got shook on Tuesday, but the market did fairly well, I thought, given the scare. So you had the S&P finish the week up 0.98%. And after a down 2% day on Tuesday, I think everybody was proven that overreacting over bullshit at Davos is just not worth it. What do you think about that?
I think, I want to say that I thought that the entirety of Europe was going down a certain path, and I don't want to get political about it, but like with respect to the economy, overregulation, overtaxation, etc. And I'm happy to start to see that there are some folks in the EU that aren't just going with the agenda of the EU, right? They have their own national interests, and they're saying, look, like this hasn't been prosperous really since we got into trading as the EU for the past 25 years, right? We've seen the US pass us by. I'd actually be very curious to see what the GDP growth of the EU versus USA has been. So it's very interesting. And I'm not talking down upon Europeans. Like I love Europeans. They're great people and their culture should be cherished and welcomed. But at the same time, their governments, just like Iran, like if you've ever met the Iranian people, the Iranian and Persian people that I've met are absolutely phenomenal, but the government is obviously a different scenario. So it's kind of like that as well. Like, you meet the Europeans and, they're beautiful, jolly bunch of people, really well educated, very smart. But then, you talk to these political figures, and it seems like they're trying to sell themselves to China to an extent. So anyway, it's just interesting and nice to see. So hopefully there's some ability to negotiate, and just like the once again, not trying to get super political here, but just like the tariff nonsense and Independence Day last year, it's always going to swing the pendulum to one side, where everyone's going to be like, I can't believe this is happening. The world is ending. Like how? and then it always meets in the middle. So I think people just need to stop being afraid of the orange man because he's orange, and just like recognize that, you know, maybe the deals are good, maybe they're not, but it's never going to be as bad as it initially is claimed to be.
I mean, without getting political, the numbers are the numbers. You can't distort numbers. So you got to give credit where credit is due. And everybody knew what they signed up for. Whether you voted for the guy or not, you know how he operates. And you know that when he negotiates, he talks big and then meets somewhere else. Everything's a negotiation. We don't have to freak out about things. And the idea of being down 2% because he starts going in on Greenland, everybody knew he wasn't taking it by military force. Like, you knew that. Now, how much of a stink he was going to put up is a different story. But the fact is that the second he started walking back comments, the market seemed to get back to normal. And you have to realize that we're in a very good situation. Lutnick comes out and says more than 5% GDP growth that they're seeing. Besant comes out, paints a really bullish picture. Sachs comes out, paints a really bullish picture. And the reality is inflation's down, rates are falling, GDP growth is expanding. Those three factors are a recipe for a very bullish business environment. We didn't have that before, and the market did well. So if the market did well with that, and the fourth factor, which is a large contributor to inflation being down, is oil trading between 55 to 65 a barrel. Now, to me, and Matt would know this much better than me, as long as oil is under 70, input costs shouldn't get out of control. The one thing that scares me is commodity pricing on metals right now, because that will hurt builders, that will hurt data center construction. It's definitely not bullish for the price of electronics or sourcing materials. I do think that silver needs to come down a little bit, and there could be a little, oh, look at Matt showing off something on the wrist. I like it. Anyway.
Can't even scratch my eye. Can't even scratch my eye.
You could have done it with the other hand. But anyway, there you go. There you go. We're in a good business environment, and I have a feeling that we're going to be in a good business environment for a while, unless something unforeseen happens. And this is a good setup for the market. This is a good setup for companies. As inflation comes down, as rates come down, I think there's going to be sectors of the economy that do well. I actually really like REITs here. And I think people are overlooking it because we talk about AI so much. I really like REITs here. I like the stronger business development corporations. I like Ares Capital a ton. I also like the MREITs here. AGNC was written off. You look at a chart of AGNC, it's doing pretty well right now. And I talked about it in a dedicated video. I talked about it on some other streams, but something like Verizon could do pretty well here. So I think there's other plays than big tech, but I'm incredibly bullish on big tech because I think the big are just going to get bigger.
Mm-hmm. I think right now you're still in this euphoric phase where people, if they want to invest in treasuries or corporate securities, they can. But I think you're right. I think that the companies that are trading at like a Verizon, trading at over 7%, or is it close to 8%? Something crazy. But those companies are going to get bid down because people are going to be looking at that 7-8% yield and say, holy crap, you mean I can invest in something that's stable like Verizon and get a 7-8% yield? So just like what we saw when zero interest rate policies came in, right? Like all these companies that were yielding very high, they all got bid up because of the fact that they were looking for yields. You couldn't get a yield in a 2-year bond. You couldn't get a yield in a 1 year. You couldn't get a yield in a 13-week. So what do? They bought dividend stocks that paid some sort of dividend and got that capital appreciation because of it, right? No longer could you invest in bonds and make money because you were at zero, right? Like generally speaking, the reason why people were so bullish on the 60-40 portfolio from the 80s to the 2010s was because you went from 18% yielding bonds down to zero. Well, obviously now we're not in that situation, right? Like the best we can get to is 5-6% down to zero. So, and that's, I think, still a stretch. So we're pretty much almost at the low. Historically, we're still extremely low compared to where we were 40, 50 years ago. So as we go lower, 2-3% on some of these 10 years and stuff like that, or maybe not 10 years, maybe, but 2, 3, 4 years bonds, you're going to see people pushing into those higher yielding companies like Verizon. So I think Verizon has an opportunity to go back to the 50s, which it's trading at below 40 at this point. But I'm surprised it hasn't maintained that with the constant decrease in interest rates over the past year and a half. But I don't know.
Yeah, when I think about it, as rates come down, the risk-free rate of return is going to be much less lucrative than it used to be. When you were getting over 5% and the whole T-bill and chill methodology was happening, I said it then that it was the stupidest fucking thing I heard. And I'll say it again now. It's the stupidest fucking thing that I heard. And I'm not going to stop cursing. So if you don't like me cursing, I don't care. That's how
Tell
I
him,
talk.
Steve.
I'm just saying, like, some people take offense to it. It's just how I talk. I'm very real. I'm not moderating the way I talk. Anyway, so when it comes down to rates, anybody who just plowed capital into a 5% T-bill got left behind by the market. Mm-hmm. Because keep in mind, when rates went up to 5.5, you didn't get that extra 50 bips. And if you were on a 1 year, the US 12M, guess what happened? After a year, you had to roll that bond over and you didn't get the same rate. So on $1,000 bond, you generated $50 in an environment where the S&P significantly shattered that if you put the same $1,000 in. So people got left on the sidelines.
Yeah, I think, everyone needs to take it into consideration. I'd say the most people, should aim for a portfolio. Well, I shouldn't, take this with a grain of salt, right? Because I can't say for everybody, but most people should look for what is the S&P 500 yield, and you should aim for, in my opinion, 2% yields, a 2% yield potentially, paying all your expenses. So if that means you need $100,000, then, in that respect, I don't know, I'm not good with math, Steve, so give me a second here. But, you should aim for a $4 or $5 million portfolio and something like an S&P 500, or, something that gets you that 2-ish% yield. Now, if you're really desperate, then sure, get the 3, get the 4. But I think that America is still strong here. We're leading. We were just talking about Europe overregulating, overtaxing their businesses at the moment, right? And hopefully it changes. But, unless you have Korea, Japan is doing rather well. You have China that's doing, but you can't really invest in China. But if, the United States is, in my opinion, the best place to invest in steady appreciation of advancing technologies, startups in the world. And so why would you not want to be a part of that? Now, I understand if you're in a different position and, you need that 4 or 5% sort of treasury or something like that to live. But if that's the case, you better lock it in a 30-year, because who knows what's going to happen the next year, the year after that, right? If you're only rolling in on like a 26-week basis or something like that every 6 months, then that could roll off. And next thing you know, your 4.5% yield just went to a 3% or 3.5% yield. And, or less within the next coming months. So,
yeah, the problem with the risk-free rate of return has always been, unless you have a large sum of money, it's not going to outpace the market over a multi-year period. And history has shown us that. Now, in this environment, people got left behind being on the sidelines, and they could have replicated that from other investments and still gotten some capital appreciation. So I also don't like the whole 60-40 portfolio idea because we saw in 23 get blown up because bonds fell, or in 2022, bonds fell a lot. So I'm not a fan of it. I'm not a fan of being on sidelines unless it is specifically cash earmarked for the sidelines that is never going in the market because you need cash on hand. Then I'm all good with money markets, short duration 3-month bonds, no problem. CD ladder, I do that with my on hand cash. But trying to manufacture income from the sidelines is just not really a recipe that I think is beneficial when you can legitimately go into a high yielding call option ETF to manufacture yield. And something like QQQI has a call spread strategy where even when it goes down and follows the market down, the options that it owns out of the money will allow it to rebound. And you're going to get 13, 14% on that. And I've ran the numbers many times. I put them in my articles. It's outpaced the risk-free rate of return so much that I would rather just build out a 5 holding high income portfolio than buy bonds. That's just me.
Mm-hmm.
But I do think companies like Verizon, maybe companies like Altria, but specifically Verizon, I think will catch a bid. Once yields get down to 3% or more, I think that that's the inflection point. Verizon paying 7% is very hard to pass over.
Now, for my question for you, Steve, are you buying it because of the 7%? Are you buying it because you've seen what happened in the past when we've gone to lower interest rate environments, and you're recognizing that it's going to go from $40 a share, $39 a share to $50 or beyond, just like it did when we kind of, I don't know, I'm trying to remember when Chris was all about it, but basically is buying it, and I think you were as well, in 2023 when we were kind of at the peak of the interest rate hike cycle, and it started to rebound as interest rates got cut. I mean, what's the thought process here? I mean, do you think it's eventually going to go back to $50 a share, or are you just buying it for that 7% yield?
Do you mind if I show you a slide
About the debt? What is it? And no, I don't mind. I'm just questioning.
Yeah, I just want to show you one slide. That's all. Just one little slide that I made. So anybody that watched my video on this, I apologize, but you'll get to hear me explain it. So as of the other day, and I did not update the yield, this was as of the other day, okay? They're paying a $2.76 dividend, 6.93% yield, 21 years of dividend growth. 5-year average dividend growth rate of 1.94%. Now, people are shook because of the debt. They have $126.96 billion in long-term debt. People are shook about that. But here's the big thing. $50 billion in EBITDA being generated. Their long-term debt to EBITDA ratio is 2.53%. Now,
It's
Matt,
not bad.
Being in energy, you know that's not bad. Most pipeline companies are between 4 and 6 on it. Now, this is not a crazy leverage ratio, even though this looks like a crazy, scary debt number. And sure, Verizon is spending $6 billion a year in interest expenses. They have more than enough money to do it. And the big part is $21 billion in free cash flow. They're only spending $11.4 billion in dividends, which gives them $9.7 billion in retained free cash flow that they can pay down debt with, that they can do a lot of things with. My thinking on Verizon, as interest rates come down, they will be able to either 1, refinance, or 2, issue new debt at lower rates. Take the proceeds, repurchase debt on the open market at less than face value, because that's how the debt markets work. If you have debt that's not maturing for X amount of years, you usually are able to buy it back a little bit less than what the face value is. So they'll end up making a good deal to buy back debt. They'll reduce their interest expenses, which will expand margins. It'll also change the leverage ratio because there's less debt on the balance sheet. I think that that's a winning recipe for this, and that's why I'm buying Verizon here. I think that this is something where you get paid a large dividend to wait. The financial impacts from the economic tailwinds that we're going to have is bullish for them. And it's going to look like a stronger company in a year from now than what it looks like now. So we'll see what happens, but I like it.
They're paying down from what it looks like, and this is an overgeneralization, but at the peak in 2021, they were at about 150 billion, and now they're at 127ish, right? So they're paying about $4.5 billion a year in debt down. So if they continue down that path at 4.5 billion or so, you know, and say they're averaging a 5% interest rate, their net income's going to increase by $200 million a year by paying off that debt. And so they're not going to be like a 20x multiple sort of company, but let's just give them at a minimum, you know, an 8x. I mean, the company, just based off of debt pay down, is going to be increasing its market value by $2 billion at a minimum, just based off of the fact that they're paying down that debt. That's not even refinancing their debt. So, and we looked at it, I think, as well the other day. I think it might get slightly worse for Verizon before it gets better, because they do have some things rolling off that are less than 5%. But like you stated, they're making $10-11 billion of additional free cash flow that's retained at the end of the year. So, you know, they don't necessarily have to keep the ball in the air. If they want to take a couple of years to really hyper focus on debt, I think they can. But I think what they're focusing on is really just continuing to get as much growth in a potentially dying space as long as they can, with like landlines and stuff like that. But now I think they're focusing heavily on the 5G rollout, which has been very capital intensive. So the fact that they've been able to get debt down while they're continuing that 5G rollout is pretty impressive. And they've always been at the head of the curve, right? They were ahead of curve on Fios. They were ahead of the curve on 4G. They were ahead of the curve on 5G. So I don't know. I think I don't think it's a horrible one. I think I'd say don't, you know, everybody run in and jump in, but I definitely think if you're looking for something that's stable and isn't gonna go to zero tomorrow and doesn't have that volatility, I like Verizon. I don't want to say it's a boomer stock, but I think it's a safe stock that you can have in your portfolio that you don't have to worry about, right? You could put money there, maybe 5-10% of your portfolio into something like a Verizon, and say, okay, what am I doing with the other 90%? Because I don't need to worry about Verizon. That's just my thought, and I think they've been always been very well run. So
I'm with you. I agree. We'll see. I mean, I think in a lower rate environment, people are going to see a 7% yield on Verizon, and they're going to get interested because as rates go to 3%, I mean, that's a lot of spread you're giving up. So,
you said Ares Capital? That's a BDC?
ARCC.
Oh, ARCC. So not Ares
Management. Gold standard in BDCs.
More than Main Street Capital?
Main Street Capital is a blip on the radar compared to them.
What do you mean a blip on the radar, Steve?
A blip on the radar compared to them. Oh. I think Main Street Capital is so overvalued, it's crazy. And I'm a shareholder. If you look at the net assets, if you look at how much net interest income is generated, you look at the multiple on NII, it's disgusting where it is.
Yeah, I don't know why people are piling in. It was a nice one. The thing that's nice about Main Street Capital is, I don't know if they still do this, but when I was an investor and heavily dividend focused, 5-10 years ago, within the last 5 to 10 years, I should say, not 5-10 years ago, because although I might have been investing in Main Street back in 2015, but the yield was much higher. But I know that they have consolidated. They might still be doing the special dividends on Main Street Capital. I'm not sure, but you're right. The yield only being 4.7% is pretty surprising for Main Street Capital. I'd have to look again at, but I don't hate it. It pays a monthly dividend. So does ARCC pay monthly?
Quarterly.
Well, Steve,
And look, people love Main Street because of the amount of value investors have gotten. I mean, it's absolutely insane. If you look at the cut sheet, which I don't have up, I'm just going to do it from memory. I think that they've generated $45 to $50 in dividend income since inception, and shares were like $20 in inception, something like that. Continuously increase the dividend. People love it. They buy it up. I just think from a perspective of value, there's just better plays out there.
Now, can you walk me through the Starwood one? I mean, I've always been a proponent of Starwood. The price has always been between $18 and $24. There might be some blips where it goes above $24, but is it just because that you're going to be able to refinance some of these mortgage that they have on the books at a lower interest rate? Is that what your thought is? So they have kind of a cost of capital, which I think is why they're being strained on right now and only at $18. But I think it's a benefit for the retail shareholder if they're looking for an income, that this is a good one. And I think it could easily, if they wanted to hold it just until it gets to $24-25 again, and then sell it and get your 20-30% return just based off of that, coupled with waiting around and getting your quarterly dividend of what? It's going to be 48 cents times 4.
It's $1.92 per year. It's around 10% right now.
Yeah, perfect.
Yeah, so I'll give you the quick breakdown on Starwood. So this is my opinion. My opinion doesn't freaking matter, only to me, right? I think Barry Sternlicht is the best CEO in the REIT sector. Now, I can't prove that. That's a personal opinion of mine. I watch every interview he does. I think he's the best CEO in the REIT sector. There, I said it again, so nobody can freaking say I didn't give them fair warning. So this is going to be a little biased, okay?
Bias me, Steve.
I've been in Starwood for about 8 or 9 years. The dividend has always been the same. Now, they were able to manage their way through the pandemic and not cut the dividend when many other REITs had to. They've been able to manage their way through a very difficult high interest rate environment, an environment where REITs were getting crushed. They do a combination of things, hotels, they do multifamily, they do big infrastructure lending. They just did a couple big deals with data centers. And one of the big things I think people mistake in this is the ability to allocate capital. Starwood has an incredible balance sheet with huge credit facilities. And here are the actual numbers. In Q3, they deployed $4.6 billion of capital. And in the first 9 months of 2025, they deployed $10.2 billion of capital. I think as the environment continues to get better for real estate, Starwood has been able to make so many investments in an environment where REITs were just hanging on and not able to make a lot of quality investments, that the next few years should really be bullish for them, and they should be able to monetize those investments. They have a very good spread on what they borrow at versus what they lend out at. And I think a lot of their real estate will get re-rated to the upside as rates come down and the entire real estate market catches a bid. Even if it doesn't, the big reason why I like it is because if it just kind of goes sideways, I'm confident in the dividend that's being paid, because you're getting basically 2.5% on the dividend every quarter. And allowing that to compound over time is great. And once again, I have a lot of confidence in Barry Sternlicht, so makes me sleep well at night with it.
Is Starwood qualified dividends, or is it ordinary? I forget. I think it might be ordinary.
I don't remember. I can't tell you yes or no. You'd have to Google it.
Let me see. Yes, it's ordinary dividends, guys. So just be careful with that, especially if you're in a higher tax bracket. If you could invest in a more in a Roth IRA with it, it'd be better in that respect, because what ordinary means is you're going to get taxed at your highest tax bracket. So if you're in like California, for example, you're going to be taxed upwards, depending on where you're at in the tax bracket, upwards of 50% of that. So that 10% yield is now going to be 5%. But if you're in a better state that, you know, that doesn't pay capital gains, like here in Texas, we don't pay state capital gains or anything like that, then, you know, you don't have to worry about that. But just be cautious, you know, specifically depending on where you are in your tax bracket and what accounts it's in. Steve, one of the things that I always was curious about. You're a big pipeline guy. We have some people piping up about pipelines in the chat. No pun intended there. But Hess Midstream. Why doesn't Steve have that in his fancy, you know, $27,000? Oh, what's that, Steve?
What do you mean?
A little ear scratch? What
Yeah, you know, I have a little itch in my ear.
Okay. Ooh, a little Pike Place?
You know, I gotta tell you, they're so nice at Starbucks. They even write me messages. Pike time.
Oh, I like it.
They're so nice.
It's the handwriting's worse than my doctor, but other than that,
I mean, you know,
that's nice. I literally drove past and I was like, I need to get home, and luckily I skipped out because that extra 2 to 3 minutes would have definitely made me late, and I don't want to be called Tanner for the rest of the stream. So
I mean, I was getting a little worried there, buddy. I mean, you were kind of pretty close.
I mean, I was just making sure that some non-subscribers couldn't just be piping up in my chat talking about God knows what. Everyone needs to be subscribed to communicate in the Matty Moolah chat. But where was I going with that? Hess Midstream. The debt to EBITDA 2024.
Do you want me to throw it into my little sheet so I can tell you? I don't follow it, so I don't know anything about it, but I'm happy to do the analysis live for you if you like.
I'd be curious your thoughts. It doesn't have the price appreciation of an Energy Transfer. I think likely because of its it doesn't have the diversification. It's mostly Bakken, but the Bakken's not going away. So I'm curious what Hot Steve thinks.
All right.
Oh, and it's down. It's down from 6 months ago at $43 a share, and at its peak in July 2025 to $35 right now, Steve.
All right. So how am I going to do this to?
Yes, you'll get for some of these. So everyone needs to keep in mind. Sorry, Steve, for cutting you off. For these real estate investments.
I'm going to keep talking. I want to rebuild something so it's easier for the stream to see. I'm not going to do it horizontal. I'm going to rebuild it vertically. So go ahead.
Build it for me, Steve. So people need to keep in mind that some of these higher yielding things, if it's a partnership, MLP partnership, if it's a real estate investment trust, those are tax vehicles that people need to recognize will pay at an ordinary income tax, right? So always just double check when you're investing some of these things that are higher yield. Be like, oh, is this a business development company? Is this a partnership, right? What does that mean, right? What does a REIT and an MLP mean? It means that you're taxed at the investor level. You're not taxed at the corporate level. So the corporate level is like a debt vehicle where they basically can issue more shares, or they can issue debt or whatever, and they're only obligated to pay taxes on anything that is more than, I think, like
they distribute 90% of their earnings through the dividend / distribution to shareholders, and they're only taxed on the remains. But in order to get that tax qualifying status, they have to distribute at least 90%.
Yeah, exactly. So that's why you're taxed at a higher ordinary rate for MLPs and REITs. So keep that in mind. It's great if you're a retiree, right? And you're only making, let's say, $80,000 a year. But if you're me and you make, let's say, more than $100,000 a year, it starts to eat away at the benefit of some of those things.
Is that why they call you Matty Moolah?
No, they call me Matt Money because it sounds good.
I must have lost the memo.
I'm actually broke.
Wait, what?
I'm actually broke.
It's from a guy who's wearing a Rolex.
It's fake, Steve. Always has been.
Oh, gotcha. Okay. I'm working on building it. If you could tell me, If you could do me a favor and get me the trailing 12 months for Hess Midstream's adjusted EBITDA and distributable cash flow, that would be amazing.
The trailing 12. The 2025 estimate is.
Give me a sec. I think I just screwed something up because I was talking. No,
Always does, Steve.
No, I don't need the estimate. I need it from Q3 what the trailing 12 number is.
They have that in here. I'm just looking at their presentation. I don't have the fancy whatchamacallit open. All right, I'll pull up your fancy whatchamacallums.
I'm not don't be doing that. I'm not fancy.
For debt to EBITDA, you said?
No. I need what their trailing 12-month adjusted EBITDA is and what their distributable cash flow is.
EBITDA. It looks like, let's see. That's not what I asked. Give me the trailing 12 month. Damn it, Steve. What website do you use for that?
I go through the actual quarterlies and put it together. Shit. I left something out, everybody. I'm sorry.
How could you, Steve? All right, I'll do the actual SEC funds.
I should share my screen, right? So everybody can see how freaking crazy I am. Hold on. Sorry, everyone. One sec. Sharing right now so you can see me putting everything together. Only because you guys are the best and Matt asked for it.
I am the best.
ET has a distribution of $33. This is 152. That is, what is that? 218 and 431. All righty. I don't have fucking share price on here. Jesus Christ.
This is ops cash, not distributable. So we're poor.
Matt, I'll do it. Just keep talking.
Yeah, 1.21 it looks like. But I don't know if that's trailing 12 month or if that's just I assume that's trailing 12 month. A lot of these things are TTM. Yeah, what other things are people curious about in the chat? Let me see. No K1s. I subsidize Rocket Lab's debt. I don't know what that means.
It means you got that money.
People are speculating that I make more than $250,000 a year.
Um,
What do I think of next? What do you think of next, Jimmy? The new CEO has forced employees to write stuff on the cut. Well, if you say forced, it doesn't sound as nice. Encouraged is a potentially better way to look at it.
God damn it.
Yes, if you own ET, you would definitely get a K1.
Yeah, that's a big thing to discuss with these. So.
People commenting that I say I look healthier. I appreciate that. I am trying. Oh, Matt Money has some linguistic parallels to Dougie Dulles. Using a lot of fancy words there. I'm going to take that as a sign of disrespect. Say, watch your
Remember,
mouth.
we're not that smart.
Yeah, I always tell when people are like, I'm very bad with people just like sending me things. So like send me a picture and I'm like, I don't understand.
What's Hess's ticker?
HESM.
It is, okay.
Steve said he's going to make it vertical.
Yeah, this is vertical versus horizontal that goes all the way out there.
Do any of your membership videos discuss the best accounts to hold maps? I assume you meant MLPs. Yes, MLPs.
That look, I'm not an accountant, so I'm not going to discuss that. There's advantages to both. That's where you got to do your own research when it comes down to it.
You got to talk to Hot Ken, the CPA.
You got to talk. In all seriousness, you need to talk to a CPA for that type of stuff.
Yeah, because there very well could be, like, for a prime example of this, and like I said, this could be complete fugazi because I'm not a tax guy, but like there's probably a crossover point if you're a retiree and only making money from income where it makes sense for you to invest in MLPs over something else because you'll get a higher yield and you don't have to pay the taxes, right? But I don't know what that crossover point is, right? And I could just be pulling that out of my butt. But like me, for example, when I'm making like let's just say $100,000 a year, it's $100,000 and say I'm making another $100,000 from, I'm going to get taxed on whatever that bracket is that gets me into the $200,000 income range because I'm making $100,000 from a job and $100,000 from this MLP. You know, if I don't have it in a tax advantage account, I'm just going to be taxed out the wazoo. So, but it still might be better than investing in a normal dividend ETF or something like that. But that's up to you to decide, right? We can't decide that.
There's also different types of things with owning it in a taxable account where there's a step down basis. So please keep that in mind.
I'm curious what Hot Steve puts in here.
All right. No, I'm just going through the press release real quick. Just give me a sec. Do they not have freaking TTM numbers in here, these motherfuckers?
All right, I'm glad it wasn't just me. Let me see. They have forecasted for 2025, but not TTM. From what I saw.
We got 9. All right, I have 9-month numbers, so hold on. All right.
Let's say they have 2025 estimates if you just want to use those.
All right, what are the estimates for 2025?
Where are they at?
Adjusted EBITDA.
Adjusted EBITDA is 1.25 billion.
Okay.
And then distributable cash flow, you said?
Yeah.
Where's that at? On a per share or total basis?
Total.
Let's see. That's adjusted EBITDA. That's free cash flow. DPS, is that what distributable cash flow is? What is that?
No.
Where's this? Volumes, adjusted capex.
You can give me adjusted free cash flow if they have it. That's probably what they're going to classify it as.
Adjusted free cash flow for 2025 estimate is 760 to 770 million.
All right. So Hess Midstream.
Educate me, Steve.
I'll give you visuals too. How about that?
Steve, this is why we pay you the big bucks.
We'll give you the visuals instead of just going by the numbers.
Are you and Tanner going to live stream the not the actual fight, but are you going to do like a watch along?
I don't think he's coming tonight.
Hot Tevis?
I don't know. Listen, I'm going to be on it, so we'll see what happens.
Oh, Hot Ken.
Ken's here.
Hot Ken just chimed in. He's on my stream, Steve. On? He's on my stream because he's got mod powers on my stream.
All right.
So if he wants
to come on, he can, obviously.
He can we could start to do the biotech numbers on some of these.
We definitely do not need to do that.
Oh,
Just
Tevis
do
straight
one
up just
more.
turning us down.
Wait, what?
Tevis straight up just turning us down. Dude, I can't believe ET is only $18 a share.
All right. So, sorry, everyone. I'm kind of fanatical about having everything look a certain way. So let's start with market cap to adjusted EBITDA. Make it a little bigger for everybody. So I don't like where Hess Midstream is compared to ET, but I think overall it's not horrible. But obviously ET is a better number. Now, enterprise value to adjusted EBITDA, Hess Midstream is awesome because they have a lot less leverage. So their enterprise value is well under the rest. So that's something interesting. The market cap to distributable cash flow is sky high compared to the other four. And I'm judging them off of Energy Transfer, Plains All American, Enterprise Pride Partners, and MLPX LP. So right now, I think they're expensive. And then when I look at net debt to adjusted EBITDA, MLPX is the best. Hess Midstream is second best. Definitely not leveraged. Now, are we getting paid to take on that additional valuation risk? Yes, we are at the largest distribution yield in the group. I don't think it's bad. I still, for 1.2%, I'd rather buy ET. Because I think
It's
ET
diversified.
I think it's super undervalued here. The reality is that you're paying 3.94 times adjusted EBITDA on a market cap basis, and you're paying 8.4 times on an EV basis to adjusted EBITDA. And then on the distributable cash flow, you're paying 7 times. So on 2 out of the 3 valuation metrics, they're at the lowest in the group. So ET is my favorite in the sector. It always has been. Fiscal AI cannot do this in seconds. So you show me that Fiscal AI can put 5 charts next to each other without flipping around everything. Now, maybe you could have aggregated this information a little quicker, but once again, and I'm not shitting on Fiscal AI. I think it's a good product. The way that I like to look at things, it cannot give me this like this. It cannot give me this like this. Period. They can't.
Period.
Period.
With a T.
Energy Transfer has like 126,000 miles of pipeline.
Yeah, I mean, I get it. I would potentially buy Hess Midstream as a buyout play. I mean, I just don't understand at what point they don't get bought out, and I think that that's likely why it's $7 billion. It's pretty much just the Bakken. At least as far as I'm aware, it's mostly just the Bakken. So I feel like it's just a matter of time.
So you know what company I really like for the Bakken?
What's that?
OKE. They're so inexpensive here. I mean, I've been buying it. It looks very cheap.
Well, I've been buying upstream Bakken assets because anyway.
Have you now? Have you now?
Little Northern Oil and Gas, Steve?
Yeah, you do like them.
I think they're bound to be bought out at some point. Steve, what do you know about this, Steve?
So give me 1 sec. Whoa, what do you got there, buddy? Flip it. What is it?
What do you know about this, Steve?
Is it a cupcake?
No, it's a chocolate dip macaroon.
Oh, tempting me, man. You're tempting me.
That's really good.
Yeah.
All I've had is a hot Jack Link's beef jerky stick. So
Listen, Jack Link is the truth, man.
why are people asking if I bought Next Decade? If you don't know if I bought Next Decade, I don't know what to tell you.
If you don't know, you don't know. Now, I did do this on a different metric, which some people may not like, because I'm adding both MLPs and C Corps. And I'm not using adjusted numbers. I'm using straight free cash flow numbers and straight EBITDA instead of adjusted. But just on these numbers, okay, ET is still the most inexpensive. The next is OKE. And when you look at OKE versus Kinder Morgan and Enbridge, which are the ones that I always compare them to because of the tax status, looks very inexpensive. And Maddie with the back-end assets, you know who has the biggest pipeline infrastructure through that region?
ONEOK, Steven.
ONEOK, baby. ONEOK.
So you're buying them as well?
I think that they are undervalued. I really like them here. And I think that those assets are going to be really good. Oh, they just raised the dividend by 3.9% also on Thursday. I love that. Up freaking 4%. I mean, that don't suck. I mean, Matt, look at these assets.
Show them to me, Steve.
No other company has this infrastructure there. I'm telling you that they're going to get bought out. This fits so well in energy. I would love for Energy Transfer to buy them. This fits so well in their infrastructure. It's crazy. They have the most activity in the Bakken and in the Powder River Basin.
They don't have oil from the Bakken, though.
Their crude starts in the Powder River here and comes down throughout Texas and Oklahoma.
They have a lot of NGLs.
They have a lot of NGLs. They have a lot of refined products. I mean, the green is refined products, so you could consider that oil, Matt.
I guess that's true.
Because, I mean, that's diesel. That's freaking other types of things that are treated. So that's definitely oil-based.
I'm curious, Steve. Do you have a map of this for ET?
I do.
Who takes, I want to say it's ET, or maybe it's Enbridge, that takes a lot of the West Canadian Select oil to kind of that Illinois Illinois, Ohio refinery region.
Oil, it's going to be probably Enbridge, I would say. But hold on, I'm going to pull them up. I'm going to pull all of them up for you. I should just rip them and put them in a deck so I have them on.
You should put them in an article, Steve.
That wouldn't be a bad idea.
Little Twitter article?
Little Twitter article for you? I mean, this is just, oh my God. Whoops, wrong one. I'm sorry.
How could you?
I screwed up. I'm sorry. Where the hell is that? What is going on here? Here we go. Look at that, man. That's such a crazy footprint. Look, and the reason I say it's a crazy footprint, the consolidation in the heaviest areas is insane. But think about this. That's why I said ONEOK would be a great acquisition for ET, because think about everything they gain in this whole area where my mouse is.
Who owns the crude offshore pipelines then?
Crude offshore where?
Offshore Gulf Coast.
Gulf? I mean, ET's got the natural gas ones.
Is this ET? Is this? Oh, this is ET. Okay,
I
I thought this was Enbridge. Okay, that makes.
No, I'm going to bring up Enbridge next.
I thought a lot of the people that I've talked to in the past was Enbridge for oil.
I mean, this is incredible when I look at this. You can't rebuild this.
No, you can't.
All right, so now I'll show you Enbridge.
I don't think it's rude to tell people to get their money up when they ask for investment advice, because sometimes people ask the wrong question. So somebody might have like $500 in their pocket and be like, what should I put this $500 into? It's like, well, it's like I could give it to you, but even if you 10x, which is a great investment return on $500, you're only gonna have $5,000. So sometimes more. Yeah, so you do have to start somewhere. So, but I think what most people don't realize is like you kind of have to come up with a millionaire mindset before you actually become a millionaire. And by just having $500 and thinking you're going to become a millionaire is very rare. So you need to be able to get yourself to $10,000, $100,000 invested before you actually start to think about the end goals, you know? So I don't think it's rude necessarily to tell somebody to get their money up. It's like, I think it's a valid point. Now it's a different thing if somebody's like 20 years old, but I think what a lot of people end up doing is they're like, you know, they're asking the wrong question, because when you don't know, it's like having an elementary school student come in to a college course and try and have them ask a question. They're not going to ask the right question. So sometimes, and I think sometimes this is where I get in trouble as well, is like somebody will ask me a question and I give them the answer to the question they didn't even ask. And whether that's helpful or not, you know, they might not view it as helpful, but you know, I might be 10 years, 15 years down the road from them in terms of experience. It's not to say that my experience is always right, but it at least might be the better question to ask, right? Like somebody might be like, where should I put this $500? To me, my thought process is you need to figure out how you need to be able to put $500 a month into your portfolio, right? Not where do you put this $500 one time, right? You need to be worried about where do I put $500 every 12 times a year? That's to me what they need to be focused on, not $500 one time.
So this is Enbridge, Matt. Huge crude pipeline is yellow.
Not enough, Steve.
It's not enough?
Not enough.
I mean, I thought they would give me a map of just liquids and stuff. Okay, not enough.
Not enough, Steve. Underwhelming.
Is it now? Okay.
One Lambo.
Never Lambo. It's a waste of money.
It's Steve.
How about Kinder Morgan? You interested in Kinder Morgan?
I do like Kinder Morgan. I used to be a Kinder Morgan investor.
There you go. Big map.
See, that's irreplaceable. Irreplaceable.
You can't replace it.
In this regulatory environment, good luck.
Not happening.
Thank you for the $10 super chat, man. I'm much appreciated. Really appreciate that.
So yeah, I like pipelines. I wish Landman would go more into pipelines, but that'd be nice.
Well, Steve. Yeah, you got to try your best, man. And I know $500. Trust me, like you might say,
we have an important question coming in.
Is it from the shadow government?
Ask Matt if he has Rocket Lab.
Who's this from, Steve?
I mean, it's from somebody important.
Yes. Yes, I have Rocket Lab.
Yes, he has Rocket Lab.
But yeah, I you know, and I'm not trying to be rude. I recognize $500 used to be the world to me. Right? When I first started investing in 2012, 2013, I'd like look at $500 and I'd be like, oh, I can't believe I'm down $3 today. And I'm like, well, I just spent, I'm talking about this while I'm eating a $7 sandwich at lunch, right? Like the sandwich cost me more than I was down for the day. And I was like miserable that I was down $3. So, I started at zero, just like a lot of you guys, right? And it might not seem that way because I've been able to do what I preach, which is add as much money as I could to the markets. And some people might say to the detriment of, my own happiness. But I love this stuff. It's my hobby. So, but when I say like I say this shit because I've made those mistakes. I've lost hundreds of thousands of dollars at this point, maybe $1 million plus by in terms of opportunity costs lost of thinking I knew too much about the markets, which I still know nothing about, right? There's so many different avenues. But what I'm hopefully conveying to you guys is mistakes that I learned and have cost me, hundreds of thousands of dollars, if not $1 million plus of opportunity cost, right? Strictly focusing on dividends when I really should have been focusing on just buying important companies that are going to continue to grow. And, that was all because I saw people getting laid off and I needed a quote unquote income stream and yada, yada, yada. And I did what I did. But had I invested in the S&P 500 in my early days of investing, I probably would have a couple $100,000, if not $1 million more than I have today. So don't just sit here and be like, Matt's sitting on a couple seven figs and he's lost touch. It's like, no, I built that. I didn't get handed it. I built it. I built it, brick by brick, investment by investment, month by month. So, you might say that I'm being unreasonable by saying get your money up, but get your fucking money up.
Can I tell you something?
What's that, Steve?
I was instructed to tell you something.
Sell Rocket Lab?
We don't own Rocket Lab.
I wish I told you about it, Steve.
I mean, I don't know why the hell you didn't tell us about it. Thank you, Rusty, for the super chat.
Thank you for the $5, my brother.
I don't know why you didn't tell me about the freaking Rocket Lab move. It's not
Can't
fair.
believe it. Not fair. I wish I told Amit about it too.
I mean, I wish you told the world about it. I wish you started a dedicated stream about it. I wish you freaking.
Thank you. Much appreciated, brother.
I wish you told everybody about Rocket Lab, man.
I'm trying to remember when we started that podcast. We're on.
Chels is right. Space Mob. Chels, did you listen to Matt? Are you part of the Space Mob?
Space Mob is ASTS though.
Oh, could be Rocket Lab also.
I guess. Yeah, it's kind of a. Anyway.
You know what's a beautiful sight? When I go into YouTube and I see that all this is purchased, and I can now watch the live UFC events for $12 a month. No more pay-per-views. It's amazing.
That's with the YouTube Plus?
No, Paramount Plus, baby.
Oh, you do, Steve, you're subscribed to something.
Yeah, Paramount Plus.
No, go back to share the screen again.
What?
Something important.
Yeah, Matt Money.
Matt Money, and what's underneath that?
The Street Exchange.
People need to be subscribing to the Street Exchange.
What, you think I'm not subscribed to you and the Street Exchange?
Oh, I know you were, but it's nice to see that you support me, brother. I appreciate you supporting me.
Come on now.
Try to get that. I'm excited for when that starts generating some revenue. We're going to have some fun. I should stop being a little, what do they call it? I'm going to use an appropriate term. Pussyfooting. Why am I pussyfooting around when I can afford to subsidize it now? And but I'm trying to bootstrap it so I don't have to come out of pocket, but I should just put the extra effort into it and get it going. I think it's me delaying just because I'm lazy. I'm not like Steve, guys.
Dude, don't bring me into this.
Don't bring me into this.
We got breaking news.
Amit talking like he's black. When has Amit ever talked like he was black? What's the breaking news, Steve?
We got some breaking news. Now, I do not know what's going on with this, and I will do my due diligence. Rudy made a video. I have not watched it yet. I will watch it and report back.
I wish I could say half the shit that Rudy says.
Rudy's my hero. Okay?
I'm so happy you introduced me to Rudy.
Rudy's my hero. Rudy is an inspiration to all. And if you don't know about Rudy, Alpha Investments on YouTube, guy's amazing. Used to be a stockbroker, used to be in finance. He is now the largest independent dealer of Magic and Pokemon cards. He's got 405,000 subscribers. He's made over 4,000 videos. Anyway, he just made a video about Hasbro sued for hiding inventory and overprinting.
No way.
I just did a little due diligence. This is what I found out. Recent reporting describes a shareholder lawsuit filed January 21st, 2026 in U.S. District Court, Rhode Island, naming Hasbro CEO Chris Cox, former CEO Cynthia Williams, and others. The core claims are that during September 16, 2021 to October 26, 2023, executives denied or downplayed overprinting concerns and portrayed a disciplined segmentation approach, while plaintiffs alleged the company was instead flooding the market with product to plug revenue shortfalls elsewhere. There's a lot of stuff in this. I need to really look at it. Craziness.
So Hasbro, for people that don't understand, I think they own Magic the Gathering. Pokemon's its own entity, right?
It's owned by Nintendo.
So yeah, okay. So Pokemon is not impacted by this particular lawsuit. I think it's Magic the Gathering and probably others.
Si, senor. Si, senor. Freaking Rudy, man.
Rudy's a good question, Steve. Because let me clarify, you're only invested in Pokemon?
See.
You don't listen to him talk about MTG or anything like that and be like, maybe I should.
I can't go down every rabbit hole.
I like that. I like that.
My brain cannot handle going down another rabbit hole like that.
I mean, Steve, you can't juggle the 100 stocks that you have in your dividend growth portfolio, the Pokemon.
Can I show you something?
Yeah.
I may have been an asshole today to somebody, and I don't care.
Sometimes you just gotta worry about yourself, man.
Sometimes you just gotta worry about yourself. So what matters?
I've been so nice to everybody for so goddamn long. It's time for Maddie to burn shit.
So as you know, I write a series on Seeking Alpha about dividends, right?
If you don't, now you know.
And some joker comes out, this is no way to invest. You would be better off buying some CEFs. And for those of you who are unaware what a CEF is, it is a closed-end fund. You cannot possibly keep on top of 100 stocks, and your first few ideas are normally your best. Is your 100th best idea as good as your first? This can be accomplished by buying FOF and CEF funds of funds with professional management and close to 8% yield. I said to him, read the actual article. And somebody else, I didn't even see this. What does one need to do to keep on top of investments? We aren't all analysts. I mean,
Steve, I like it. I do often think it's funny when people will say something and you're like, that literally was discussed in the first 30 seconds to a minute of the video.
It's like if you read the article, you will understand exactly what I'm doing with this. Like, it's not hard. I actually put the whole freaking thing in this section right here. This section explains what I'm doing with this. And I specifically say, I started this account with $100 with the goal of documenting how I would build out an income-producing portfolio from the ground up on a budget of $100 a week. The reality is that this type of investing isn't for everyone, as there is a large cohort of investors looking to generate as much alpha as possible. While I have many investments for generating capital appreciation, I also have many investments in income-producing assets. I intend to continue this account for another 20 years in addition to my other income investments with a goal of generating enough income to live off of without touching my actual retirement assets. This account is now producing $2,739.40 in forward dividend income, which is a 7.95% yield across the portfolio. I mean,
Steve, have you forecasted how much yield this is going to be getting in the next 20 years?
No, I've never modeled it out because it's too hard when you think about, all right, so think about this.
You're already you're already over halfway, like from what you invest every month to getting that back in dividends.
Yeah, I'm about 57% of the way there.
That's insane.
So when you think about this on a year-over-year basis, the blue is the first year that started in April. And then the red is the next year, the yellow is the next year, or orange is next year, then green, then pink or purple, whatever you want to call that. And the blue is this year, all right? The reality is that when you look at the last calendar year in the purple, I'm averaging around $200 a month from this.
Insane.
And the immediate goals of this are reoccurring dividend income and risk mitigation. Capital appreciation is a secondary goal. And when you actually look at the performance, the blue line is invested capital and the red line is the account value. This is the Russia-Ukraine war start. The worst that this portfolio has ever been is down 12%. I'm not looking for this to double, triple, or quadruple, but it spent a lot of time in the black. And you look at Liberation Day, really not that scary in this portfolio. And it just keeps generating income and it keeps getting plowed back in. So now I'm putting $5,200 a year into this. And right now I'm generating over $2,700 a year in forward income. By the time that this year is over, this could be doing $3,200, $3,300 in forward income.
That was always my favorite thing to calculate because like it always like Albert Einstein is right. Like it's the most beautiful thing in the world. It's like one of the most beautiful things in the world. So just think about it. 2,700 alone, right? If you just take that 2,700 alone and you had like a 7.5% dividend yield, just reinvesting that 2,700 is an additional $200 a year. So that gets you to 2,900 for the year, just before you even added the additional capital, right? Then let's just say, what do you think, Steve? What do you think the average dividend raise you get of the portfolio is?
I don't know, because there's a bunch of stuff that doesn't increase the dividend.
So what do you think? 3%, 4%, 5%?
Less.
I think it's less.
If you're going to take everything into consideration that has zero, yeah.
Okay. So what?
But if look, there's a lot of things that have good increases. There's a lot of things that have high income. I mean, look, I think that you'll like this chart the best. It's not a chart, it's a table. Those are the top 10 holdings. I mean, I have not added to Altria Group in 2 years. February 24 is the last time I added to them. It's still the number one holding because it was so undervalued. This thing's generated 31% of my initial investment in dividends.
Yep. I like it.
I mean, it's not for everybody, but I happen to like this stuff.
It's fun, man. It's definitely a cool spreadsheet exercise. But just goes to show people, like, you don't have to invest millions of dollars to be able to do okay. Like, think about it.
How much started with $100?
How much could you? I mean, think about it. $200 a month. You know, you could turn that drip off, and really, even turning that off, you pay a couple cell phone bills. You could pay part of a car. You know, that's really good money. So
look, at some point, this will generate $1,000 a month.
Oh, easily.
Potentially in the next 4 to 5 years.
Steve, I am thinking you will exit, not have, but exit the year between 3,300 and 3,400.
Yeah, that's reasonable.
So divided by 12, you're fucking closing in on $300 a month, dude.
Yeah.
You'll be at like 275 to 285, I think, a month average. That's insane. That's so fun.
Yeah, and the thing is, look, I'm in a different situation than a lot of people, and I'm fortunate enough to be able to put $100 into this a week outside of other investments. That may be a lot to some people and may not be a lot to others. To me, it's just one other investment that I make per week, and it's doing exactly what I want it to do.
But even if somebody can only do $100 a month, $25 a
It's
week,
fine.
divide everything by 4, and that's where you'd be at, right? Like if you think about it, it's like, obviously you can't replicate everything, but even if you were to say this is a benchmarkable portfolio to what somebody can do, they'd be getting 57% of that back after 5 years. So that's only after 5 years. It's going to build on top of itself. So say you have 10 years down the road, you're like, well, I have the money now. For example, prime example for me, I have the money now. So if I was like, okay, in 10 years time, whatever I'm investing, I'm going to get 150% or 125, 150% back a month on what I'm investing now. I have working capital. So it's like, if I'm able to add that, let's just say I'm able to add $1,000 a month, I might be able to then pretty reasonably assume $1,500 a month in 10 years time. That's not bad.
No.
It's not bad.
And look, you can go straight high yield and only do ETFs. You don't even have to venture in individual stuff. If you could legitimately build a portfolio with 5 things, okay?
Mm-hmm.
You could do SPYI, QQQI, GPIX, GPIQ, and then PDI. You'll probably average out around 12%.
Steve, you inspired me. I don't know. I might have said this on Chris with the Cash for Chronicle stream or not, but you inspired me when I was doing more Seeking Alpha articles, which I actually got an email. They said, we'll give you a bonus if you write 2 articles before the end of February. So I might be coming back.
Whoa. What?
I might be coming back, Steve. I might be coming back.
What did they tell you?
They said, you need to be more like Steve.
No, they didn't. But what did they tell you?
They said, we noticed you haven't written an article in a while because you're a slacker.
Yep.
And they said, we'll give you a little bonus if you hit the sheets again.
Now, did they tell you specific stuff to write about or not?
No, they just said 2 articles.
So you just got to do 2 articles and they're just going to give you free money.
I mean, we're not talking hundreds of dollars here, Steve.
I'm just saying, I know what they're going to give you.
What are they going to give me, Steve?
I'm not going to say it live.
What are they going to give me?
You want me to say it?
Yeah, it's not.
They're going to give you 45 to 60 an article, correct?
Well, no, they're not just the articles. They didn't say they'd give me per article.
I'm talking about as a bonus.
Oh, they just told me $60 total.
Oh, 60 total just to write 2 articles?
Maybe it's 60 an article. Let me see. Maybe you might be right.
I'm just so.
You might be right, Steve.
You're good. You should do it. You're a good role model. I don't know why you stopped.
Let's see. You're right. I shouldn't have ever stopped. We're offering a $60 bonus if you submit before the end of February.
Do it.
Get back in front. Which, I made a spreadsheet. People may or may not know this. I made pretty much like hey, this is when I wrote about X, because Steve has to worry about these things. I never wrote enough where I needed to worry about these things. But Steve writes enough where he literally has like however many companies he writes on. So he needs to make sure that he doesn't write about them too much. So I created a template so that way if I wrote about a company, it shows up with conditional formatting that if it's been more than 90 days, that it shows up as green and that I can write about it, right? My hope is that I'd have a couple stocks that I always follow, Rocket Lab, Palantir, etc., and always be writing about those companies because I like them. and I'm already following them. So hopefully I'd be able to. Yes, you can make great money on Seeking Alpha.
I don't know what you're talking about.
You're not going to make Steven Fiorillo money on Seeking Alpha.
I don't know what you're talking about.
Because you're probably not going to write 4 to 5 times a week. But if you did, maybe you make Steven Fiorillo money. Steve, how you don't have to, I'm not going to ask you numbers, right? But how does your dividend portfolio article compare to your normal article about a specific stock? Is it as good, slightly better now? Still building?
It does all right.
Does it do better than a normal article? Worse?
It does all right.
God damn it, Steve.
It does good. I mean, look, this is what I'll tell you. The last one that I wrote had around 8,000 page views.
People are following Steve.
I didn't even realize this. I have over 40,000 followers. When the hell did I break 40,000?
Dude, that's insane.
40,701 followers on Seeking Alpha.
If people aren't following Steve on Seeking Alpha, you don't have to be a member, right? You don't have to be premium. You just have to follow Steve.
I'll put the link.
But if you don't follow Steve, then I will fight you.
I put a lot of stuff out on there.
In fact, I'm gonna when people come up to me in the meetup next weekend, Steve, I'm gonna be like, pull up your Seeking Alpha. If they're not following you, I'm gonna be like, we're not having this conversation. I don't know who you are. Don't come and talk to me. You have to wait at least an hour.
Don't start with that.
And I have a timer. Every person that comes up to me that doesn't have it, I'm gonna have a timer of at least an hour. And if they come back to me before an hour, I'm gonna slap them in the face.
Look, there's a lot of good investments out there, and I do think Seeking Alpha. Look, I am not sponsored by them. I don't have a link. I don't make any money saying this. Okay. I do think it is worth every penny for the research, because not only do they do a good job of getting all the numbers up there, you get all the earnings stuff up there, but you get so much information from different points of view out there that, to me, it's just very good. So
yes.
I like
it's definitely when they were, before you had to have a premium subscription, they had a lot of people contributing. And on some of it I was like, ugh, but now that it's premium, I think they do a lot better job of filtering people out.
Yeah, I would agree with that. And they're very hardcore on the use of AI. Like they scrub every article. Like you cannot use AI to write. So it's good. I like it.
Never tried. Yeah, never tried.
And don't do it. Don't do it. So Matt, you got Rocket Money in 30 minutes, right?
Rocket Money, 30 minutes. About to make a thumbnail, Steve. What should I ask you to make me?
Well, I think you should use one of the ones you've already made.
Why?
What do you mean? I mean, no, use the one from the Philosophical Investor.
Oh, good point.
That was great. I mean, I do like this one.
Maybe I should ask you to switch it to, instead of Armageddon, Rocket Lab Weekly. I like that one more personally.
The role model.
Which one do you like more, Steve?
I like both. So let's end on this. You got Meta, you got Microsoft, you got Apple, you got Tesla reporting this week. Which one's got the most opportunity for alpha, Matt?
Is it Meta, Alphabet? Sorry,
Nope.
Meta,
Meta,
Apple.
Microsoft, Apple, Tesla.
The one I feel most confident will have the most alpha is Meta. And it's because they're coming off of that $18 billion write down or write off that they had in the third quarter. I thought it was overblown. That's why I established a very small position. I wish I had bought more, but I'm cautiously optimistic that it'll be like, hey, we're back to normal. You know, that write off that we had. And that's the thing. It was just a write off. Like it wasn't even like they had to like anyway. So it's not like that money disappeared, right? The money still came into the coffers. Cash flow from ops, like the ops cash, never went down. So I don't know. To me, it just anyway. But I think in terms of the biggest alpha opportunity, it is Meta. But I think Tesla could always come out with something that you know that they're signaling that by the end of next year, the Optimus robots will be able to be purchased for commercial customers. We'll see how likely that is. But if they present something very solid, that could move the stock a good bit as well. People will now say, okay, they're on the path to $10 trillion market cap, etc. Alphabet, or not Alphabet, Apple, I can't get behind right now until they it's an EPS game with them. I'm more about long-term earnings potential of the company. Their EPS is going to be great because they keep buying back stock, but I don't think they're investing enough to keep up with the other Mag 7. And who was the last one? Microsoft?
Si, senor.
Microsoft, man, I just think they're just going to be Microsoft. Like they just continue to deliver over, 25 to 35% revenue growth quarter over or year over year. I'm just amazed. So I'm very curious to see how they show up, if their margins are shrinking.
Dude, I hate to cut you off, but we have breaking news.
Who made something?
The philosophical investor, like, I want to meet you, okay? I am so hoping that I get to meet whoever the hell this is. Are you ready for what they just did?
Yes.
I don't even know how they came up with this, okay? This is ridiculous. Spencer forever holds the rank of AI GOAT. Like, where do you guys come up with these ideas?
U.S. troops deployed to Greenland. Operation Ice Shield initiated. Spencer's a baddie in that photo. I'm not gonna lie.
Dude,
Spencer's always a baddie, but
ridiculous. Absolutely hilarious. What is this?
Spencer promised she'd be my wingman in New York.
Dude. Oh my God. Freaking Spencer. Now I know why, because I didn't see this before. Spencer freaking made this, and I guess that's why the philosophical investor made the other one.
Spencer's got skills.
And it gets, there's one more. Hold on. Matt, this is crazy. Word is that the White House quant wants Canadians to pay 100% tariffs on fiscal AI.
What does someone on the say? The Gill King?
Rocket Lab, freaking milk.
The whole milk. What does that say? The whole milk. Sleeping Beauty Tanner.
Crazy.
I like the Eagles with the cigars. I might need to steal that.
AI's getting ridiculous.
I like the Empire State in the background.
AI is getting ridiculous. So go on. I didn't mean to cut you off.
No, that was pretty much it. I mean, 25, 35% for Microsoft. I mean, I think it's just, I don't think that Microsoft's been hit too bad lately. Let me double check. I might be speaking out of my butt there. I remember having conversations with my brother back in 2020, 2021, and he was working with a guy. Microsoft was like 150 a share. He was like, he worked at Home Depot at the time, and he was like, this guy keeps telling me that I need to buy Microsoft. He keeps coming in every day, and he's like, did you buy Microsoft yet? And my brother kept telling me this. I was like, Microsoft? I'm like, I mean, they're doing great, but like, they're already so big. How can they continue? This is before I really started getting involved in like high growth names and stuff like that. I was more dividend focused. He was right. He was right. Oh, Microsoft came down a good bit. It was a 533. I'm talking out of my butt. Okay. But
it's come down a lot.
33 times price to earnings though. But if you think about the growth of say 30% per annum, if the net income is able to do the same, 30% per annum, I don't know. I don't think it's that expensive. It deserves a premium regardless because it's Microsoft and their moats. So I don't know. But I think Meta is probably, I wouldn't be surprised if you see Meta over 700 after the earnings if they have a good one.
Meta's my horse. I can tell you that right now.
I thought I was your horse, Steve.
Meta's the horse. So, all right, Matt, I think we can cut it. I know you got to go. Thank you, everybody, for being here. Matt will be on in 21 minutes with Rocket Money. And I will be back at 9:30 tonight. Hang out with everyone. Enjoy the rest of the day. Please go follow Matt and please go watch Rocket Money Weekly because he is on fire.
Thank you, Steve. You're the man. Appreciate you inviting me on.
All right, everyone. Have a great afternoon. See everyone at 9:30. Thank you for being here. We wouldn't be doing this if it wasn't for all of you. Have a great day.